DTI and all the, what is DTI? I know it's debt to income ratio.
I was gonna say death to income ratio.
I'll be quiet. I'll sit this one out.
No, I'm sitting it out too. Mr. Gupta, go ahead, man.
Okay.
Let's talk about
how much money you make.
loan qualification. You guys have been talking about the market being different now. Regulations, new regulations have come to play. So what are the new credit scores? I know you touch base on it when you're talking about the different programs, but if you can just quickly dive in quickly and just give us the new credit scores requirements.
Before we start, there is other programs are there where people don't have a full documentation. It's called or a self-employed program.
I was gonna get to that later on.
You're gonna get to that. Okay, that's good. Then let's show what your advice. And maybe you forgot about. Okay.
So give me the current credit scores needed for FHA, VHDA, VA. I know you touched on it when you were talking, but sure. I just want.
Well, that's kind of a gray question right now because, and it's a common misconception. None of the agencies have changed any of the guidelines. And by agencies, I mean FHA, USDA, VHDA, Fannie Mae, who am I missing? Nobody, the programs themselves haven't changed any of their rules. What has changed are the servicers' requirements for picking up these loans. So it's the companies that are actually collecting the mortgage payments. And if you think about it like this, here's how I've been explaining it to my customers, going back to the forbearance thing. If, Aaron as a lender is saying, or Aaron as a servicer is going to say, hey, I'm going to borrow, I'm going to go ahead and start collecting payments for Anita, for her loan, okay? Aaron knows that when he collects payments, there's a lot of stuff that happens on the back end. Aaron knows that he's making commitments on the interest that he's ultimately collecting off of that loan to, let's make it simple, fund Mr. Gupta's 401k or whatever investment portfolio he's essentially securitizing against that income stream, times all of the millions of people buying houses. If someone comes out and says, hey, I know things are tough right now, you don't have to make your mortgage payment for the next 3 months. Well, Aaron's going to be like, well, snap. If these people aren't going to be paying these mortgages, how am I going to pay Mr. Gupta off, on his portfolios, on his retirement portfolios? So now what Aaron has to say is he's going to have to go back and look at his books and say, based on the performance history of these loans, I'm noticing that anything lower than 660 has a higher default rate. So now he has to say, you know what? I want you to have 3 months reserves in the bank. I want your credit score to be better than 660. And I want you to, whatever other rules that he wants to put in place in order to agree to purchase the loan that I want to create, for you, Anita. So what happens is when you come in and say, well, I have a 620 credit score. I'm getting all my money as a gift for the down payment. I don't have any reserves. Aaron's like, that's too risky right now. So that's what we saw at the beginning of April is everybody said, well, I will go ahead and say everybody said, you know what? We need now, although FHA will allow you to go down to 500 credit score, we are going to require for us to collect servicing, we are going to require that you have a 660 credit score. Now, me as a bank, doing your loan, Anita, I say, okay, I still want to do loans, but I can't service my own loans, meaning I can't collect my own payments because when you go to closing, I have to be able to send real money in the form of a wire from my warehouse lines to your closing so that at your settlement, your title company can pay the seller. If I service too many loans, I run out of money to lend. And if I run out of money to lend, I can't lend anymore. So what happens is now me as the bank, I have to play by Aaron's rules so that he can deliver on what he's promised Mr. Gupta. And if Aaron won't pick up my servicing to do your loan, everything grinds to a halt, which is essentially what we're experiencing right now. So the loans,
Go on, sorry.
But I was just going to say, so it's not that the loan rules have changed. It's what do we do with these loans after they close? Because there's a high probability that their forbearances are going to come into play. In the month of April, forbearances went up 2,000% in the first 15 days of April once they put that announcement out. So as servicers across the board, when you're seeing those type of numbers, you're scared because you still have to deliver. You still got to make your obligations just as consumers still have to make their obligations. And so that's what we're experiencing. That's what we've seen. That's what we're trying to navigate right now. So as we get more clarity from the government and from, the different agencies that are supposed to be helping, the servicers with this, then we'll see hopefully guidelines loosen up to back to what the agencies allow, which will then free up the money markets. And because everything is all jacked up, with the amount of money that the government's pouring into mortgage-backed securities, trying to keep everything as stable as they can, then you'll see rates level out, and I will actually go on this call on record and say the rates will be very low for a very long time, period. Because there's no way that the rates are going to be able to tick back up to what they were projected to do previously.
Especially with the way that unemployment is looking as well.
Exactly.
A lot of this has to do with our health as a country. We're going to start to see a lot of changes. I think, Gary, that's probably, truth be told, that's been probably the best explanation that I've heard about it. Another guy explained it. He says, think about if you owned a business and all of a sudden you had 100 customers and 10 of them said, we're not making payments for 6 months.
Mm-hmm.
Now you have a certain level of reserves, but how quickly do you want to go into that reserve bucket? And now you're starting to think, well, what happens to the next 200 customers that we get in? Because we're all lending money. We're like Gary, it's the best explanation. We're all hedging that money on something else. It's all being lent based upon another financial instrument, mutual fund, for whatever you're thinking about. And remember, servicing is an income as well. So lenders are actually buying the right to collect payments. If you have a portfolio that you clearly have enough, like Gary said, enough data on to where there is specified data that says there is a portion of this portfolio that is going to be non-performing for the first 6 months, you don't want to buy that portfolio. And as a matter of fact, you're probably going to try to figure out a way how to rule out some of that portfolio from any of the loans that you're purchasing. And that's how we got to where we are.
Yep. Bottom line is right now, if the credit score is 660, that is a good way to start. There are few investors who are still doing with a lower credit score, but how soon they're going to go away, no, we don't know. But 640, 660, that's the benchmark.
So what I'm hearing is the regulations are still intact. It's just the investors are driving the new changes, right? Because they don't want their monies out there, and it's just
they can't take the risk.
It's all risk-based. Everything is risk-based at this point.
And I'm actually kind of happy to see it. Truth be told, yes, it's made, I think we would all agree, it's made our jobs a whole lot more challenging, to say the least. But unlike 2006, it probably was the right thing to do rather than just to because at the end of the day, none of the three of us, I think, really good loan out. Nobody, of course we all want to get paid, but we don't want to see people homeless. We don't want to, Anita, I have a motorcycle license. And one of the things that they told us in the class was, when I got my license, was please be responsible. We hate when we see articles where we know somebody in our class killed themselves on a bike. Same thing. To check back with a customer just to say, hey, how are things going? It's the worst. And I've dealt with it personally. It's the worst to hear that they fell on financial hardship and they had to foreclose on a loan that I created, because now I'm second guessing. Did I miss something? Was there something I could have done different? Did I give them all the information, or, is it just life happened? You know what I mean? And so I'm glad that, they're being more strict, even though it's made our jobs difficult. And for the most part, I think customers get it and they understand it. But in the same way that we all, of course, have been advised to wear masks in public for the better of the public, whether you're sick or not, same thing, going back to the forbearance, make your payment, whether or not, if you can, make it, because it will be better for the economy as a whole. The more people that are keeping up with their responsibilities is really what it boils down to.
I truly love the honesty and integrity, the level of integrity you